markets. Good evening and welcome to the program. I'm Edidiong Iwang. Well, as the coronavirus pandemic continues to ravage markets around the world, the market here in Nigeria is not left out. The Nigerian equities market has seen sell-offs over the past month, with several stocks trading at historic lows as a continued slide in oil prices, as well as uncertainties around the coronavirus situation, continues to suppress broader market performance. Joining me now via Skype to talk more about the market is Oise Ajayi, an associate at Meristem Securities. Good evening, Oise. Thank you for joining us on the program.
Good evening, Edidiong. Thank you for having me.
Okay, so can you give us an overview of what's happening in the financial markets right now?
Financial markets right now is particularly, well, in Nigeria, activities are kind of mirroring activities in global markets. We've seen a lot of sell-offs since the start of the year. We've seen, investors take profit here and there, and then prices have fallen, like you mentioned, prices have fallen to historic lows. Bond prices have risen as well due to more sell-offs in the market, and then we've seen a lot of buying pressure in the Eurobond space that has brought yield prices much lower and yields much higher. And then in the FX space, we're seeing trade at much higher prices than we would like. And then, like I mentioned earlier, the equities market has taken a significant beating so far in the year. Year-to-date return currently is into the negative at about -15%, -15% return as at Friday, with the huge sell-offs across various counters, across various sectors in the market. And this is actually no surprise. I mean, we've seen what happened with the spread of the coronavirus across global markets, and we've seen how markets or investors have reacted as well. And then it's no surprise that the Nigerian market is also taking a beating in this period.
Okay, so we've seen some earnings come in this week. Generally, how will you say companies have performed so far?
So far, it's been relatively mixed. We've seen most of the banking results, pretty well. GTB did about 50 billion in profits. Access did about 40 billion. UBA did about 30 billion. That's Q1 in terms of Q1 profits. In the consumer goods space, we've seen Cadbury, we've seen Nigerian breweries, mixed bag for both of them. Cadbury grew top and bottom line, but breweries are clearly is still struggling with his expenses, which has continued to drag his profits over the periods. But so far it's been a mixed bag, but more of good than bad in the markets so far. The banks are still doing pretty well, and then to be fair, we're really not going to see the impacts of the coronavirus or the impacts of the lockdowns that we've seen, or the impact of the slowdown in economic activity until Q2 results have been released. Then we can get a proper view of the impacts of this. So for now, we're only seeing a light or a slight impact of developments on these companies so far. But so far so good. It's been relatively impressive for most of the companies who have released their results.
Okay, so if we dig deeper into GT Bank and Access Bank, what would you say were the major drivers there?
For GTB, we're seeing stronger interest income. You'd have expected, many people expected lower interest income in the period, but we're seeing stronger interest income. Non-interest income as well is relatively encouraging, and then the bank has been able to keep some a good grasp on its expenses, which has enabled it to provide such profits over the years. Although we saw a slight uptick in its cost-to-income ratio to about 40%. But it's still best in its class. It's still best in the sector. It's still one of the best we've seen so far. For Access, we saw a slight decline in profits from about 41 billion in Q1 2019 to about 40 billion in Q1 2020. So far, from what we're seeing in the books, they took on huge FX losses, about 52 billion thereabouts. Which significantly impacted your books. But nonetheless, we're relatively confident in the performance of the bank. We're confident in the ability to replicate 2019 performance, or maybe even do better. But depending on, how deep the impact of the coronavirus is, or the depth of the slowdown in economic activity is, then would be able to, then we'll get a clearer picture of, or we'll be able to, provide better estimates or better forecast on what these companies are going to do. But so far, so good. They're still in relatively, strong positions.
So are there new products that banks can offer to improve their earnings going forward?
For now, I mean, given what we're seeing in the markets right now, it's a dicey situation for all and sundry, right? So you don't want to put out a product that in a relatively stable market will do well, but because of the current situation, current economic situation, current global situation, you're finding it difficult to actually push this product. So yes, a lot of products can be put out. I mean, the CBN has continuously pressured banks to be innovative, and then we've seen the CBN put various policies in place to ensure that these banks are not resting on interest from government securities to boost their books. So yeah, there are several products that can be put out, but does the market favor these products right now? That's where the question is, or that's where the challenge is. But nonetheless, we expect to see various innovations from these companies, and then we are not putting anything beyond any bank in this period. I mean, profit is key. Profit is the goal for all of them, and then in this period where commission has been cut, so many banks are expecting lower fees and commission income, except they're able to significantly drive transaction volumes, which every now and then can be a chore. But yeah, innovation, we're not putting it beyond any bank, and then the question is the timing. Is this the right time to put out this product? Will this product sell in this market, given the current situation of things?
Okay, some companies have declared dividends. Now, would you say that that's advisable at this time?
Well, for many companies, for many of them who have declared dividends, I mean, we've seen a bunch of companies declare full-year dividends, and that has cost across some various sectors. So for many of them, it is about maintaining that culture, right? Maintaining that culture of constant dividend payments over the years. And then for many of them, I'm pretty sure that a proper analysis of the current situation has been done, a proper analysis of their books has been done to ensure that even if a certain amount is paid out as dividends, it wouldn't significantly impact their books going forward. So yes, good of these banks to put out dividends. In fact, we saw Union Bank declare a dividend for the first time in a long time. Wema Bank as well, amidst talks of recapitalization of the banking sector and all of that, we've still seen them declare dividends. I mean, the result was released this week, and they still declared a decent dividend, given where they're coming from. And then it's really, I mean, you're trying to cajole your investor. You're trying to ensure that your investor confidence in your company is still the same. That is not waning. People are, people still have faith in your company, because barring the economic situation in the country, or what we're saying globally, various investors have different investment styles. Some people are there for the dividends. You take away that dividends, they pull away their funds. You see your share price fall, and you can't take out the bandwagon effect, where people see prices falling and then failing to understand why investors are selling off. They hop on that bandwagon as well and sell off. So yeah, it's been quite encouraging from this company still declaring dividend in this period. But going forward, what we might see could be a reduction in the payout ratio of many of these companies, right? Given the current situation, or maybe even same payout ratio, but given the expectation of lower revenue and earnings for many of these companies, there's a high chance that we'll be seeing lower dividends going forward. But if you recall, many of the dividends being declared are from 2019. So nothing from 2020 yet. Projections are still on course, are still being reviewed by many of these companies in the wake of the widespread of this pandemic and the slowdown in economic activity.
So like you stated earlier, for Q1 earnings, we're not really going to feel the impact of the coronavirus. So going forward, how do you see this affecting earnings?
So, I mean, the expectation is that it's going to impact earnings negatively. A lot of companies, are trying to deal with this current situation on ground, trying to be innovative, trying to create new products, trying to find new avenues to generate income, probably even, other income streams, that differ from their core business, activities. So many of these companies are going to be doing a lot of that. But for many of these companies as well, it's going to be a Herculean task. So, I mean, look, if let's taking the consumer goods sector as as the sample, as much as consumption is essential and as much as consumption is key, it's no denying or there's no beating around the bush about the fact that many of these companies are not operating at optimal capacity right now, and you can't fault them for that. The lives of their workers are at stake, and then the lives of their workers are paramount right now, which they have to ensure that is being protected. So many of them are not working at optimal capacity. Production has slowed down for many of these guys. You're not seeing a strong increase. In fact, there's no room for an increase in price because of the current situation on ground. So for many of the consumer goods companies, or for many companies in general, services, consumer goods, we're going to see a slowdown, a significant slowdown, because there's no sales, really. If there's no sales, there's no revenue. If there's no revenue, what's going to trickle down to bottom line? And then recall that many of the expenses are going to be fixed. They're going to have a lot of fixed costs, which will still be incurred regardless of whatever the company produces or what it doesn't produce. So for many companies are going to take a beating. Consumer goods, services sector. A few companies, on the other hand, might profit from this. Looking at the healthcare sector, there's a lot of room for many of this, for the companies in that sector, to grow their earnings significantly because of a high demand for many of their products. However, that also depends on what space they're playing in. Looking at the oil and gas sector as well, we know what's going on with oil prices. We know how low oil prices are falling. Being hit by the pandemic as well is sort of a double whammy for most of these companies. So it's going to be a really difficult year for many companies. Many companies have to be innovative in this period, but revenue and earnings are very likely to take a beating in this period.
So at a time like this, when everyone is trying to hold on to whatever cash they have, there would also be companies looking to raise debt instruments. Now, are there people willing to invest, and is there any market to absorb capital at this time?
I think there's a lot of room to invest. We saw what happened with the Dangote cement issue, the bond issue, 100 billion was well oversubscribed up to about 156 billion. So for many companies, it would depend on their credit rating and how they're perceived by the investing community. If your credit rating isn't strong, you're not a big player in your space, chances are you'll be looking towards an undersubscription, except you have your issue underwritten. And in this market, that's going to be hard to convince any investment bank to undertake for you. But like I said, if with a good credit rating, there is a market for it. Remember that the PFAs have a lot of cash on their hands, while say normal maturities every other month or every other week, in fact. And then these funds have to go somewhere, right? So, I mean, come with a good credit rating, come with a decent yield on the offering, and then investors are going to, mop up whatever you're issuing in the market.
Would you say this is a good time for companies to invest in derivatives?
So the derivatives market is dicey, and then so far so good. I mean, the players really enjoying the derivatives market now are people who got in 3-4 months ago. I mean, if we're talking about FX derivatives, we know where the dollar is currently, and the people who have gotten into these positions prior to now, most of the players that are going to be enjoying all of this. And then currently in the market, we've seen a lot of FPIs selling off and trying to exit the market, but that has been relatively difficult for them. So these, are some of the signs which other investors who are looking to come into the market are going to be looking at, and then it's going to, push many investors away. So what we're going to be seeing in the market right now will be players who have pending dollar needs, coming up in the near term, in the medium term, and then they are not trying to take any risks against the dollar. So they're going to be trying to take their position right now. So those are the players that we're going to be seeing in the market. So for many of them, it would be a case of we don't have a choice but to go in now. For many who have a choice, I think many of them will still try to stay away from the market and then see, where things go, in another maybe 1 month, 30 days, thereabouts.
Oise, there was a bond primary market auction on Wednesday where the DMO allotted instruments worth 156 billion naira. Now, what does that say about the government's domestic borrowing strategy?
To be fair, I think it still says the same thing. Maybe they're trying to increase the amounts being borrowed right now, given the current economic situation. The original amount on offer was supposed to be 20 billion each on each tenor or on each instrument, and then we saw huge subscriptions, and then the government raised the amount allotted to a total of 156 billion from an expected allotment of 60 billion. There's no denying the fact that why in a dire economic position, and then there is a huge need for funding the government, for funding government activities, or funding the economic activities as a whole. And then the result of that auction really speaks to it. Also speaks to the level of demand for fixed income securities or for relatively safe securities in the market.
How is the drop in oil prices affecting the market now? I can't go without asking you that question.
So the oil prices have dipped to historic lows in the last couple of days or in the last couple of weeks, and it's really difficult. We're in a really difficult position. And Nigeria, I'm talking about. We had an oil budget of $30 per barrel. And then now we're trading well below that. The initial budget was $57, and then when that was brought down to $30, we saw the huge gap it created in the budget. And then now we know where it's trading at. So oil revenues have significantly declined, and depending on how long this progresses for, we might be seeing a huge underperformance of the budget solely because of this oil price. And then the global investment community, is looking at Nigeria and then other oil-dependent countries, and then trying to estimate what the next move is going to be, because with lower oil prices, we're expecting depletion in foreign reserves, and then of course you can't deny the pressure is going to place on the currency, which we're already seeing, and then dollar is trading at much higher prices than expected, or than it was trading at a few months back, and then this speaks to the rate of default, not just for the government but for companies as well, because there's too much tied to the oil price or to oil in Nigeria. Debtors, creditors, all of that. Too much of economic activity is tied towards the oil price, and then the situation is not being helped by the global pandemic. So banks, various other companies, various other financial institutions have, huge creditors in the oil and gas space, which cannot service their debt because oil prices are low or are much lower than they expected or are much lower than they bargained for. And then, the situation is being worsened by the COVID-19 pandemic. So the current, dip in the equities market that we're seeing, is feeding from both effects of the oil price, the extremely low oil prices, and the pandemic. Of course, not taking away, bandwagon effects and then, bargain hunting and profit-taking activities, by investors.
Well, Oise Ajayi is an associate with Merisem Securities. Thank you for coming on the program, and do remember to stay safe.
Thank you very much. You too.